Okay, again, this is live, March 29, 2016, at about 3 minutes past the hour, 12 o'clock if you're on the East Coast, 10 o'clock if you're from where I am. So we're going to be talking today about the money net. Now, if you do happen to be catching this as a recording and you have questions about today's class, go ahead and send your questions to support@radioactivetrading.com. I'll flash that up on the screen at the end today. Let's see. Oh, and I have a special gift for everybody that's attending live. Okay, so that's some good incentive to to come to these classes live if you get a chance. Okay, so let's go ahead and get started there, folks. We'll get off of my ugly mug here. Question is asked, what's the Hebrew writing on my forearm there? That's actually my wrist. I own a martial arts studio, and because I own a martial arts studio, I've got to constantly take my wedding band off. So this is my wedding band. It's Hebrew. It's from the Song of Solomon, and it says, I am my beloved's, and my beloved is mine. So thanks for asking. That's kind of an intimate question, but yeah, I guess I'm showing my tattoo there. Okay, so in today's class, I promised you the money net. And this is a fabulous, fun trade that we do here at Radioactive Trading. We call it the money net because it captures, in many cases, more premium than if you had done a covered call, and also has the wonderful side effect of being able to capture money twice. It's kind of exciting, okay? And I told you in the email that you responded to today and came today that it's a combination of a bull call spread and another secret ingredient that lets you get paid to put on the bull call spread. Interesting. That's kind of cool. All right, that's the truth. But I need to set the stage a little bit. All right. First off, I wonder how many of you got your start or maybe even still trading covered calls as your primary way of taking income from the markets. And the reason that I'm asking this is that this was the, poison pill. This was the gateway drug. This was what got me started trading options, was the covered call theory. And it blossomed into something good, but by itself, it really wasn't that great. So anyway, I'm just wondering what kinds of trading you do now. If you happen to be in covered calls, still let me know. If you're just playing with stocks right now, or not playing with, but doing stock plays. I realize that investment is a serious business. If you happen to be doing spread trades, which we're going to show today, we're going to show some pretty exciting spreads. By the way, you can vote in more than one category, okay? So choose all that apply. Okay, we had a question. Question comes in. Oh, it's a comment, really. Judy says, covers calls don't pay me with high commissions. Yeah, when you have high commissions, it's no fun. Okay, so I've had that pull up there for a few moments, and the majority of the room, 80%, at least that 82% now, that have answered say that they're doing simple spreads. So that's kind of cool. It shows me that when I flash up a bull call spread, you won't be lost. Okay, you're going to know what's going on. It's kind of cool. Okay, let me go ahead and close that poll because we're at a minute exactly, and I don't want to have these things go on for very long. So it ended up being the majority still. It was at 1.82. Now it's 79. 79%. That's first place doing simple spreads. Second place doing covered calls. Wow. Okay, so we've got a lot of investors still doing covered calls. Okay, and then in third place, a tie, combination plays, and risky stuff. Wow, we got a lot of folks doing risky stuff. Interesting. That's a much higher result than usual. And 21% of you are doing stock only. Okay, so just real quick, I'm going to ask, how's that working out for you? And there's a reason for this. I'm asking you this so that I can show you a possible solution for your situation. Whether you're winning or losing, or winning but losing. There's a category for that. Picking winners more often than losers, but still losing money. I believe that I'm able to help you. Okay, I believe that I'm able to help you. And we'll just let this poll fill in for just a very brief period of time. It's been 30 seconds. I'm going to leave it up for only another 5. Okay, so 3, 2, 1, and close. Okay, this is very interesting. The way this played out is not the way it normally does. I normally don't have this strong of a showing in the fourth category. I usually do see about 20%. Thank you, sweetheart. I usually do see about 20% in the first category, and today I see 0. Okay, 0% of you saying I picked more winners than losers and won last year. Okay, so we're not great stock pickers, are we? We're not great with our timing, are we? All right, but 50% said I picked more losers than winners and lost last year, and that's not surprising. If you pick losers more often than winners, it's not surprising that you lose. Okay, money. But then 30% picked more winners than losers. Okay, you were right on with your stock picks. Okay, you won more often than lost, and yet you still ended up behind the 8 ball. Now that's actually more common than you would think. Okay, but here's something that's highly uncommon. Something that's highly uncommon is picking losers more often than winners, but still winning overall. And it's you guys that are, first of all, my heroes and the folks that I started to emulate way back when I began to come up with radioactive trading. Okay, you're my lobster. Okay, you're my enchilada. You're the guys that I'm into. And secondly, I can show you how to do this. Okay, so we're going to look at that today. We'll look at how this is done. Okay, now I had a question come in. Okay. Calls and puts, says Ron. Yep. Oh, okay. So calls and put. Ron is trading calls and puts rather than the answers that I showed. I wasn't able to show everything. Okay. Okay. So I'm going to show you my cool triple dip structure in a moment here. In just a moment, I'm going to show you my cool triple dip structure. But first, I want to show you the line of thinking that began in 2002 to bulletproof your stocks. Okay. No dip. No joke. So here's a structure that causes you to solve the biggest problem with trading covered calls. And there is a problem. Have you guys noticed what that is? Have you seen it? There's actually 2 really big problems. Uh-oh. Ron says sound cut out. How's everybody else doing? Are you still hearing me okay? I'm going to make an adjustment to my mic here. Let's make sure we're on. Okay. I'd like for you to text in if you got me loud and clear, okay? Yes, 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 yes. Lots of the letter Y's. Okay. And another yes. Okay, good. I figure most of you can still hear me. Great. Another okay. Good. So here's the structure that causes you to solve the biggest problem with trading covered calls, and that is the married put. Okay, the married put trade. And that's where you buy stock but also buy a put option. Okay, and so now at this point I'm going to slip over to power options, and we're going to look at the power options screen here. Particularly the one that is called custom spreads. Okay, custom spreads, because there's all kinds of, I mean, you can, for example, if you go to the married put tab, you'll see my book, the blueprint, featured there. Okay, Power Options is not my company, okay, but they do sell my book, and it's because the guys in the office, even though they've got all kinds of different options plays available to them, guess how they trade? They trade using my system, and the reason is that it works. Okay, and so if you were to go to this married put tab, you would be able to search and find in the universe of all the options that are being traded right now, you'd be able to find the ones that are best for our particular structure and strategy. Okay, looks like there's 2 pages of them. Kind of cool. Okay, by the way, by showing this, I'm not making a recommendation one way or the other. I've got to make that disclaimer. That's important. Okay. All right. So here's what we're going to do. We're going to go instead to the custom spread tool. Okay. And put in our stuff there. Now I'm going to use a well-known stock. I'm going to use Starbucks for my example. And we're going to do the plain vanilla married put. When I say plain vanilla, what I mean is the way that folks most often do the married put. So right now, or actually 20 minutes ago, this is delayed quotes, okay? So 20 minutes ago, 20 minutes ago, Starbucks was trading at $59.24, okay? If I was to do this in the traditional way, let's say that I believe that within the next month, Starbucks is going to go up, all right? But just in case I'm wrong, I want to protect myself. So I might go out 30 days, okay, and pick a put option. This is plain vanilla, understand? Plain vanilla put option. And what I'm going to do here is pick the, let's say the $58 put. Okay, all right, so now we've got stock, we've got a put option. I add these together, and voila, the most I can lose in this play here is 3.9% or $235. On the other hand, if the stock goes up, I'm going to do pretty well. Okay, now I'm not paying very much for this put option. I'm paying $1.11 for insurance. All right, and if the stock goes up, great. If the stock goes sideways, well, you know, I lose this $1.11. Okay, $1.10, $1.11. If the stock goes down, though, whoa, hallelujah! Not hallelujah that the stock went down, but hallelujah that I had the $58 put in place. That keeps me from losing too much. Okay. All right. Now that is a plain vanilla married put, and we're going to show a better structure than that here very soon. But I'm showing you the line of thinking. Okay. I'm outlining it from the beginning. What bothered me about covered calls, and stop me if I'm wrong, but what bothered me about covered calls was number one, when I would buy a stock that was volatile enough to have a sexy premium, you know, when I sell the covered call, I found out that it was volatile enough to also go down, and it could hurt me. Okay, now that's not something that they really publicize very much in those covered call trading seminars, but the first big problem with trading covered calls was that it could hurt me. Okay, and so what I began to do was I began to add put options to my stock. Now, I want to show you something interesting. Here's the married put with a covered call added. We're going to go to the PO screen again, power options screen. And let's also go out a month. All right. Now, again, this is not what I am showing you. I'm just showing the line of thinking. What I'm going to share with you today, I think you're going to really dig. It's going to be something else. Let's sell the $60 call option. Okay. And when we do, if the stock goes up, that's going to be awesome. If the stock goes down, that's going to be not awesome, but not too bad either. Okay. Okay. This is a cool little backward Z, and we call that a collar trade. The collar has stock. It also has a put option protecting the stock, and to the upside, it has a cap. All right, because of that short call, this is as high up as you can go. You can't win very much more. All right. Now, I want you to take a look. The maximum risk here is 1.9%. Okay. The maximum return here is 1.5%. I might want to make a little adjustment to that, so I think I will. I think what I'll do is I'll make this just a little less cost. Okay. So that we can actually gain a little more than 1.5%. We're going to make that a lower cost. And where are we? Boom. I'm doing all this live. Okay, that's why it's, and it can't be prepared. I can't prepare it. You know. All right, but let's go ahead and spend a little less on our put option. Okay, and see if that helps. We might even spend less. Okay, so instead of a 1.5%, now we're looking at 1.7. I wonder if we can get that to 2. That'd be awesome. Let's see if we can do that. Okay. Now there's a reason for this. There's a reason that I'm going through these shenanigans here. And okay, we'll go with the 57 put. That's cheap. That's cheap. All right, here we go. Okay, so we're buying a $57 put option. We're also selling a $60 call option. And we own the stock. Okay. Now, ta-da! All right, 2%. We can make 2%. That's marvelous, okay? And we're not going to lose that much if we're wrong. We're going to lose 3.1% if we're wrong. So this is actually a pretty good kind of a deal here. It's all right, okay? Now, I'm going to put up a similar structure. This is a similar structure. It's not the same structure, but it's a similar structure. And that is the bull call spread. Now, interestingly enough, the bull call spread is going to seem very much the same. I'm going to enter that in a completely different setting here. Okay. Sorry, I should have logged in already. All right, here we go. Custom spreads. And what did we have? We had a short call, right? and stock and a long put. Okay, now here's what we're going to do. We're going to go to Starbucks again, but this time we're going to make it strictly out of options. What we're going to do is go to the same expiration months, and we're going to buy, instead of buying a $57 put option, we're going to buy a $57 call option, and then sell the $60 call against. Okay, and watch what happens. It's going to look almost the same. Almost the same. Look at that. Okay, a very similar structure. It's not exactly the same, but it's very similar. Let's click between the two. Here's the bull call spread, and then over here, blip, is the married put. I mean, those are twins, separated at birth, right? Look at that. Okay, over here on the left, okay, left tab, we're looking at the what do you call it? The collar trade, where you buy stock, you also buy a put option, and you sell a call against. And then over here, we've got the options only position. Now, the maximum profit is $91, okay? The maximum risk is $209, okay? Maximum profit, 91. Maximum risk, 209, okay? So that's your bull call spread. On the other hand, with the collar, okay, the maximum risk is a little bit less. Instead of 209, it's 185. And the maximum profit is a little bit more. It's 115 instead of, what was it? Instead of 91. Interesting, okay? So this is one reason why I play stocks instead of simply doing options. I can do a little bit better. But here's another reason, and we're going to take a look at the reason here, okay? Why would you use a married put plus a covered call instead of just doing a bull call spread? Why would you do that? Why not just do everything with options, okay? Well, I'm going to show you the result of that, and what we're going to do, and this is totally unplanned, all right? I mean, it's planned to a certain degree, but I want to use livestock prices, okay? So I didn't give you a historical thing that happened 5 years ago. I'm showing you something that's happening in the market right now, okay? Let's go over to the Trade Simulator tool, and let's say that we're doing bull call spreads, okay? First of all, let's look at our bull call spread and see what our parameters are, okay? We can make 43.5% return if we're right. Whoa, hey, that's awesome, okay? Let's plug that in. 43.5% return. Now, unfortunately, we can also lose everything, right? Because when you buy this structure and then sell a call against it, when you buy a long call and sell a short call against it, it's going to cost 209 in this case. But guess what? 209 is the cost, and 209 is also the risk. But what do you say Starbucks starts to go against us, right? Starts to go down. And instead of losing everything, instead of losing 209, we're able to manage it, and we only lose, say, 100, okay? So that would be a 50% loss instead of a 100% loss. We're going to go easy on ourselves here for this demonstration here. All right, let's say that our loss limit is not 100%, but it's 50%, okay? It's 50%. All right, so now let's run this simulation and see what happens. Well, not cool. We started with $10,000 and won some, lost some. Okay, we got a 50% probability going on here. Won some, lost some. We ended up bankrupt. Let's try it again. Bankrupt again. It just took us longer. Okay, bankrupt again. Bankrupt again. Every time it falls below $250 a share, we're bankrupt again. There we are, 250, bankrupt after 10 trades. Here we are. This took 55 trades, and we're bankrupt. How about that? Wow, not cool. Okay, now, what I'm going to do is I'm going to change one thing about this, okay? What I'm going to change about this is I'm going to change how much we have invested in each trade. Instead of 100%, let's just only make it 10%. And then what happens? Well, now we're going to do differently. Oops, you know what? I forgot. I wasn't supposed to do that. I was supposed to do this. We're gonna make this change here to where the maximum risk is 3.1 and the return is 2%. Okay, would that be good? Where was I? 3.1, 2%. Bam. Oh, and we can actually run this. Okay, here we are. Boom. Okay, see, now we're losing more often than winning and yet still making money. Losing more often than winning, and sometimes losing as often as we win, and we're still making money. Why is that? Okay, it's because when you lose less, you have the opportunity to stay in the game. When you lose less, you know, if you were to lose 50%, then you've got to double your money to get back to where you started. But if you lose 5%, you don't have to get a 100% return. You don't have to double your money. You don't even have to do a 10% return. You have to only do a 5.26% return. And the fact of that, the fact that forcing an ideal size trade works, okay, is the foundation of what we call forcing an ideal size trade. It's the foundation of radioactive trading. Okay. All right. So using that trade simulator tool from radioactive trading, I would say try this. Try this a lot. It's a real good exercise. Okay. All right. So now we're getting somewhere. I just showed you the most important principle of trading if you're able to receive it. All right. So let's move on to a very different type of married put. We're going to talk about the radioactive profit machine. Okay. The radioactive profit machine. Now, here's why I pick a put option that's far away in time, okay? The radioactive profit machine goes like this. Instead of, where are we? We've got our Starbucks. Instead of buying a put option that's near to us and also out of the money, okay, we're going to pick a put option that's far away. First, let's take a look at this one. $57 put option keeps us protected to the tune of, say, 5%. You could only lose 5% with this play, but you're protected for how long? You're protected for a month, 30 days, okay? All right, now, what I'm going to do is I'm going to take out that put, and I'm going to put in a different one. We're going to go out, say, 100 days or more, okay? Maybe even 200 days. Okay? Let's make it 100 days for this example. Okay, real easy to wrap our heads around. And instead of going out of the money with the $57 put, let's go in the money. Let's actually spend a little extra on this put option. In fact, we might even go in the money a little bit more. We'll find out here in just a second. Let's see if that gives us a 5% result. Oh, that's even better than 5%. Oh, good. We're going to stick with this. Okay, so what I've done here is actually spend a little bit more on the put, haven't I? I've spent more on the put, but that gives me more protection, like 3 times as long. Okay, instead of 31 days to expiration, this is, let's look at it again, June. That's 108 days. I'm sorry, that's July. 108 days to expiration. Instead of 5% at risk, now I've only got 3.9% at risk. Isn't that something? Okay, so this is what we call the radioactive profit machine, and here's why I pick a put option that's far out in time. It may seem like I'm spending a lot on that put, okay? That put was what? It was like $3 and change, and the near term out of the money put was less than $1. It was like 79 cents or something, 82 cents. All right, but why would I do that? Why would I pick one that's far away in time? Well, you'd think that buying a put far away in time is too expensive, but it isn't, okay? And the reason is that time value falls off slowly at first. This decay curve, we call this the red line, radioactive exponential decay. This is why we call this the radioactive profit machine. Now, here's the thing. I don't have to hold it for 120 days or 108 days or whatever. I don't have to do that. If I'm buying that that put option clear out till July, what is that, 108 days, something like that, I don't necessarily have to hold on to it for that long. What's a month from today? Today is March 29th. Let's look at April 20-something or another. April 29th, okay? And what's going to happen is, see this red curve here? That's where our stock is going to be, stock plus put option is going to be valued. If the stock goes up, great. If the stock goes down, still great. We're not going to lose more than, say, 3.9%. And in fact, if it stays the same, we're going to lose, in this case, it looks like 8 cents. $8 on 100 shares. We're going to lose 8 cents if the stock stays the same and the put option decays in time just a little bit. Okay, so if I want to just hold this thing for 30 days and see what she does, I'm really looking at only losing a small amount. All right, and if I wanted to buy that put option that's 30 days away, well, shoot, 30 days, the decay, most of the decay that happens in this option happens in the last 30 days. It falls off like a rock. All right, so this is why when we do these structures, we buy an option that's far away in time, giving us better protection, giving us more options, not to make a pun, all right, and we're not fighting the clock. If I only want to hold it for a 30-day period, I'll hold it from here to here instead of holding it from here to here, all right? That's it. Now, in the interim, in that 30 days, we're able to take income one of 12 different ways. Now, I'm going to show you the money net. I'm going to show you what we call income method number 5, or the money net. But let's go back to our example of the bull call spread, okay? The at-risk amount of that spread is what you pay for it, okay? But what if we could get paid to have that structure in place? What if we could actually get paid to have a bull call spread in place? Well, one way that we've learned to do this is to sell a call. Now, if we sell another call, we're going to end up with a new structure that's commonly known as a ratio call spread, okay? And there's a problem with that. If you sell a second call, you might end up with infinite risk, and infinite risk is a problem. And I told you that there's a way to do this completely without risk, okay? There is, but there's a catch. You got to own the stock. All right, you got to own the stock. If you own the stock, then you'll be able to do a ratio call spread without risk. So let's take a look at the radioactive profit machine play. We'll go back to the power options screen. Okay, there's our radioactive profit machine play. And how much do we have at risk dollar amount? Can everybody see that? I just want to make sure. Go ahead and text in. Let me know if you can see it. Okay. Frank says he was doing credit spreads in the SPX for 4.5 years, 23 winners in a row, and then 4 losers in a row, and the 4 losers wiped out the account. Wow. Not fun. Ron can see it. Mike can see it. Okay. Rick wants to know why not go further in the money. I'll go ahead and show that, Rick. I'll show why it's not wise to go further in the money, okay? All right, most everybody says that they can see it, okay? So that's $244. Now, that's going to change here in a minute. But what I'm going to do is I'm going to switch over to this other screen here where we have the bull call spread, okay? And I'm going to change which bull call spread it is, probably. Let's see. Yeah, I'm going to need to. We're going to have to make it a different bull call spread, but we're going to make it in the same time frame, April, okay? So 31 days from today's date. Okay, now let's take a look here. I think we can certainly, yeah, looks a bit like we can certainly do one right here. Bam and bam. All right, so here's what I'm going to do. I'm going to buy one of those, and I'm going to sell one of these, and this is going to be a what? Bull call spread. And how much can I make with that bull call spread? Well, I can make 45.6% return on the money that we are risking. And what are we risking? We're risking 103. Now, here's the thing. If I put together this play, I can make, okay, you can make $47 profit, okay? But if you lose, if we lose, we're going to lose more than twice that amount, all right? We're going to lose $103 loss. Not cool. Okay, so what I'd like to do is I'd like to erase this red. The way that I'm going to try and do that is I'm going to sell 2 of these. Okay. Now, by selling 2, instead of paying to get in, we're getting paid to get in, right? The total cost, if you look down here, the total cost is negative. We're being paid 16 cents to get in. But there's a problem. Now, if the stock goes up, That's when we experience infinite upside risk. Not cool. Now what is cool about this is, hey, we get paid 16 cents to get in. And then later on, let's say that Starbucks is at $60 at expiration. If it's at $60 at expiration, those $60 calls expire worthless, but this 58.50 call that we've been paid to own is worth $1.50. So as you'll see, the maximum profit is $166. 16 for doing the spread in the first place, and then another 150 if those things expire worthless. And here's the thing. If the stock trades along sideways, all right, we're going to get paid a second time. If the stock goes up higher than 60, we're going to have some management to do, but we'll get paid a second time. And the only problem with this, it's kind of a glaring problem, is that we have infinite risk to the upside. Again, this is selling 2 contracts of Starbucks against 1 contract of Starbucks. The 58.50 call and selling against it 2 $60 calls. Okay, now here's the deal. That looks like infinite risk. And I just told you I was going to do a riskless play. Okay, well, here's the deal. It is riskless in this context. If you recall, here we are with our married put, which is actually a very special arrangement of a married put, in the money put, far away in time. Okay, we call it a radioactive profit machine. And the most that we can lose with this is 244 if the stock goes down. Now, here's what happens. We're going to add to this the ratio call spread. We're going to buy calls and sell 2 against. Buy 1 58.50 call. Whoops. I'm going to buy Q of them. All right. I'm going to sell 2 against, and it's going to be this play, right? It's going to be this play, but it's going to be that play in context of owning the stock. And let's see what happens. Bingo! Look at that. If the stock stays flat, we're going to get paid a second time. We know that already. We're going to get paid a second time in this ratio call spread, right? But if the stock goes up, as it's going up, what happens is our stock is gaining really fast, and we're happy with that. At the same time, our, our ratio call spread is also peaking. It's gaining. Okay. Now, if it goes really high, we could get into trouble. Okay. But in this case, if it goes really high, we're probably not going to get in trouble until it's really, really, really high. And even then, it's not going to be too much trouble. Let's say the stock goes to $65 a share. Well, by golly, then we'd be looking at a loss of 12 cents a share. See that? Okay. So it's not that unlimited upside risk. And in fact, let's take a look at another structure. What if we were to just add 100 shares, okay, and 2 puts? Then we're going to have our ratio call spread still in place, still where we're taking a premium, right? We're taking a premium, but accelerated growth in this zone, and still unlimited upside if the stock decides to keep going up. Kind of cool. Well, guys, what do you think about that? I mean, what do you think of that idea that you could take income while allowing unlimited upside for your stock? Would that be kind of cool? Okay? That's awesome. Now, here's what we're going to do. We're going to go back down to here, 101. All right, we're going to go back to there because I wanted you to recall something. The risk used to be 245, didn't it? What's the risk now? 234. It's less. It's less. Why is it less? It's less because we collected a small premium, right? That's what that ratio call spread is all about, okay? So if we look at let's do this one more time, okay? If we're looking at the married put alone, all right? We're looking at the married put alone. It has a risk factor here of $2.44. And if we add in the ratio call spread, we're going to reduce that. It's going to go down. If we are buying the 58.50s and selling the 60s against, and sell 2 of these, and instead of 244 at risk, instead of 244 at risk, it's going to be 234 at risk. That means that our ratio call spread did not insert any capital risk. In fact, it took away from the capital risk of this play. Well, that's great, but what does that mean? Well, I'll tell you. If we keep doing this, okay? We already showed that. What's the benefit? If we keep doing this, we're going to be able to pay for those puts, okay? Here's the benefit. First benefit is this. You collect a credit for doing this, okay? We looked at the risk with and without the spread. The risk had been 244, and then it went down to, I forget what it was, 230 and change, okay? All right, that's the first one. Here, let's go to the power options screen and look at that, all right? So the risk is, okay, it's 234 instead of 244. That's the first deal, all right? Here's the second benefit. You may collect a second credit. That's why we call this the money net. So let's say Starbucks goes to 60. If Starbucks goes to 60, the $60 calls are going to expire worthless, but the 58.50 calls are going to be worth $1.50. So we're going to collect another $1.50, okay? Here's the third benefit. As your stock goes up, you also gain from that. As your stock goes up, you also gain from that. Hey, we're long on the stock, and we like it when our stock goes up. Okay? And then fourth, if you do this enough times, you'll pay for your put option, effectively ending up with a bulletproof stock. Let's take a look. Let's say that the ideal scenario is that Starbucks goes to 60, but let's do something less than ideal. Let's say that Starbucks goes to let's just say it stays flat. It goes to 59.17. If that's the case, we collected 16 cents already, and this 58.50 call will be worth 67 cents. Okay, so what do we got here? 16 cents plus 67 cents equals 83 cents. Now, 83 cents comes off of the cost basis of our put option, right? Oh boy, here we go. Minus 320. And so now this will be worth 237. How about that? Now, if that's the case, then what will happen is we'll have a lower risk. We started out with 244 risk. Now it's down to $1.61. What if we did this a second time, where we were able to capture 80 cents worth? Well, that'll make this $1.57, right? And so see the red water running out? We still have unlimited upside potential, okay, whenever we don't have short calls in place. And then, hey, you can do this in a weekly manner. I actually recommend that you do it like 3 to 4 weeks out. But let's say that we were to do this again. Let's just look at what if we had reduced our cost basis by doing income methods. What if we reduced our cost basis a bit, and we decided to go for this? Let's sell 2 of these against 1 of those. And essentially what we'll have here is going to look like a seahorse, I think. Yeah. What we're doing is we're making ourselves bulletproof, and we're able to continue to play the ratio call spread, but play it without risk. That's what I promised you in today's email. I did tell you there was a catch. The catch is you got to own the stock. But you own the stock and it's protected, and as you are protecting it, you're able to do this play multiple times if you like, and if conditions work out correctly, okay? If your stock doesn't just go in the toilet, you might end up with what we call a bulletproof stock, okay? All right, so that's the show for today, guys. That's what I wanted to show you. I will answer some questions. We practice 12 different ways to enhance your profit and reduce your risk, or do both at the same time, okay? You can enhance your profit with some of your income methods. You can reduce risk with some of your income methods, and you can do both with some of your income methods. Today's was one that you can do both, okay? And if you'd like to know more ways to do these kinds of maneuvers in more kinds of markets, eliminating the fear of losing or the fear of losing out on the upside and making the most that you can. All right, you're nodding your head yes, I can tell. All right, then pick up the home study kit on your way out today. Okay, all right, so I'm going to flash up this right here, talk about our guarantee, and then I'm going to hit the question pod here and answer some questions. Might also pull you. Jeffrey says, awesome, I'll be signing up in the near future. Okay, cool. And Jeffrey has left. Jeffrey just left. Do we receive a replay link, says Yin C. Yin, I believe, yes. I've got a recording going on right now. We are going to post it. Okay. Rick says, Rick asks, what is the best time or conditions to use income method number 5? And I still want to know about the diminishing problem when you buy a put too far in the money. Okay, so 2 questions. So let me give you the answer to the first question. Rick wants to know when's the best conditions to use income method number 5. The first thing, Rick, is I wouldn't sell calls that expire after an ex-dividend date, so that you're holding short calls during the dividend X date, okay, if you happen to be trading a stock that pays dividends. The reason for that is that if you are in the money, if you have sold a call at 55 and your stock is trading at 56, all right, and you're in the money like that on the dividend X day, your stock will be called away early. That's just a thing. It happens, okay? And it makes for some sloppy management. So that is a time not to use income method number 5. Now, a time to use income method number 5 is when you've got swelled up options premiums. And you would want to sell as near to the money as possible. For example, today I was trading with Starbucks at 59 and change and selling the $60 calls, not selling the $55 calls, and not selling the $65 calls. $55 calls would bring in a lot of premium, yes, okay, but they would also bring in a lot of liability. And selling the $65 calls would not bring in the right premium. Okay, but selling at the money is the best, okay? And buying slightly in the money. Okay, so great question. Rick, Alexander wants to know, would like coaching. I have the home study kit. Alexander, I am taking on 1 new client on April 1st, and that is all I have room for. I do have some other folks ahead of you, but I would be pleased to entertain your application. So if you want to send that to Kurt F., not support, but Kurt F., K-U-R-T-F, at radioactivetraining.com. Just write coaching in the subject line, and I'll send you back an application, okay? The reason why I'm not taking on many clients, I only work with personal clients in a very limited capacity, and I've got a schedule, okay? I'm going to be on a missions trip in June, for example. Be going to Uganda from June 2nd to June 14th, and I'd like to have all the folks that I'm working with, I'd like to have their trades already handled and squared away so that they don't need to ask me anything while I'm away. Okay. Rick just got back for a mission trip in Honduras. God bless you, Rick. Appreciate that. Cool. Okay, guys, let me go ahead and show you the next few slides. I'm going to talk to you a little bit about the home study kit, all right? And Alexander wrote in saying he's already got it, so that's marvelous. The 100% guarantee means that you have unlimited possibilities, but you're bulletproof. And I don't necessarily mean bulletproof in stock. You're bulletproof in this offer, okay? That's really the only thing I can guarantee. I don't guarantee that you're going to bulletproof yourself in your stocks. That would be irresponsible because I don't know what the market is going to do. I'm not like one of these gurus that you see out there that say, hey, I'm going to teach you how to make 3 to 6% every month. By the way, how's that working out for you? I know that some folks, I'm just going to ask the covered call traders that have done it for 24 months or more. Why don't you participate in this poll, okay? The covered call traders that did it for 2 years or more, not if you got out of the seminar last week and you sold a call and you got 3% premium, you're excited. Okay. No, I'm talking about if you did this for a period of time. Did you double your money? That would be the truth of 3% per month compounded. Or did you quadruple your money? That would be the truth of 6% per month. Okay. I'm giving this to you guys that are out there now. Here's the deal. I've had one person reply saying that they doubled their money. Wow. Okay. I'd like to challenge you what time period that was. If you'd like to send me your record, I'd really like to see it, because it's like a UFO. I could believe it. Perhaps if I saw it, but never have seen it. Nobody has ever sent me a 24-month record where they started with $100,000 and they could absolutely withdraw $200,000 at the end of the 24 months. Okay. All right. Let me go ahead and close that poll. I'm going to share. So we did have one human being. This is a very small amount of today's class actually qualified, right, to answer the poll. I said 2 years or more, right? Okay. So the percent of the percent, 20% equals one human. So one guy said, yeah, I did it. All right. Well, that guy's a unicorn. I believe that it could be possible. I just had never seen it. And I'd really love to see your record and hear your tips. Okay. Another one person said, I'm ahead, but not like what I was promised. Two people said, I'm about flat, honestly, and one person said, I don't get it. I'm losing money, and I want to know why. Well, the reason that you're losing money is by capping your upside and leaving your downside open. And what a married put does is exactly the opposite. It caps your downside and leaves your upside open. And that's really the kind of algorithm that you want to use. Okay? All right. Now, I'm going to go ahead and put up this testimonial. I'll answer a few more questions. Pardon me. Got the hiccups. Okay. Dear Kurt, I have received the blueprint and I'm a total believer in the methods. Thank you so much for sharing the idea of bulletproofing my stocks. In the last 6 months of trading, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. Now, real quick, let's see how that might be possible. Okay? He says that he managed it without loss. Let's go back to this. Okay? Where we've got today's price Starbucks and today's price for the book. No, today's price is something else. I changed that because I was showing, okay, today's price is $3.10. I changed it to show the result of taking income. Okay? All right. So we got 3.8% at risk, or $234. Now, what if we were to use, I'm going to just put in income method number 6 here. What if we were to use income method number 6, okay, and sell a near-term call and buy a far-term call and collect a little bit of premium today. Okay, so right here we're collecting 83 cents. Okay, 83 cents. Well, what if the stock backtracked a little bit? Well, the stock backtracked a little bit. It actually says, I'm backtracking it a bit here. It actually says 14-cent profit. Okay, so what can happen is your bear call spread, in this case, closes, and you get to keep the premium, and your put goes up and your stock goes down, but your put goes up by a few cents. You collect your income method and your stock goes down a little bit. Well, the difference of having your put go up and collecting your full amount on your income method, this is what happened here to Sudhakar. He was able to manage 6 out of 10 stocks. He was able to manage all of them with no loss, and some of them make a small profit. And some of them I even made money. All right, so I just wanted to show how that could be possible. All right, your stock goes down a little bit, but your put goes up to counteract it, and you get to keep your money from your income method. That's how you make money on a stock that goes against you. How about that? Okay. I wish I had known about bulletproofing a year ago, says our writer. He says, I am still recovering from some huge losses I incurred a year ago, but since having gone through bulletproofing methods, I'm very excited to use put options more gladly than ever before. I'm slowly making my progress. And What is most heartwarming for me is that all of my portfolio is bulletproofed. Thank you again so much for the blueprint. Sudhakar Rajalu. So very cool. All right. So guys, the blueprint is $339. The home study kit is the advanced version of the blueprint. It actually doesn't contain any more income methods. It's the same amount of income methods, but the home study kit comes with 6 audiovisual CDs that are animated portrayals of how this works. So if you learn better that way, it's a better investment. If you're on a budget, or if you feel like, well, geez, I just learned just fine with text, then the text is a better value. Okay? All right, very good. And so let me hit those questions here, and then we'll let y'all go. Open the questions here. Thanks, Kurt. I have to go. Great stuff as always. See you, Martin. Okay. Yin says, can you give us more details about your program? Yes, Yin. Actually, I didn't even put up the link. I guess I should. Okay. Go ahead and do that. Hang on just a second. I see Frank's comments. I'm going to get to you, Frank and Rick. Hang on just a second. All right. You're going to want this link. Okay. See up here at radioactivetrading.com. If the common rabble wants to know about the products, okay, if somebody just comes and visits the site and they check out the products tab, this is what's available. Okay. It says the blueprint $339, buy it now. The home study kit $599, buy it now. All right, and it talks about all the different features and benefits. All right, but if you guys that are on today's live class, or folks that registered and are in the recording, okay, if you type in radioactivetraining.com/Iridium, you'll get to the sales page, but it will have 5 unadvertised bonuses, and these bonuses together are worth more than the blueprint. And you get to keep the bonuses even if you return the blueprint or return the home study kit. So it's worth knowing. Okay, so I'm glad that somebody prompted me on that. Let me get back to the questions. Appreciate that. Let me open this up again. Okay, we got a couple of questions. Frank asks, oops, let me scroll up because Frank gave me a long one. I sold covered on IOC for 12 months. Low options volume, hard to roll calls. Done in IRA, no paper trading. Okay, so you did it in your IRA, you weren't paper trading. But what I found out was that many times I got fills over the mean. Maybe because I was the only game in town. It sounds like they were the only game in town. You're the only customer, huh, Frank? Overall made 30%, but in hindsight, could have sold the stock 3 times that year for a 90% profit. Yeah, see, that's the problem with selling covered calls, Frank, is that it cuts off your upside. Now, if you had done an income method number 5 play, you might have done better. Okay, an income method number 5 play gains on the stock, and it also gains on the play. You know, so that's kind of cool. Let's see. Rick says, I need to make money with radioactive profit machines and income methods consistently before I can afford power options. Can you please show me, if you have time, diminishing return and problems as we go farther in the money buying far out put options? Oh, you know what? You asked me that before, Rick, and I should get into it. Okay. Ed asks, how much is the home study kit if we already own the blueprint? Hang on, Ed. We'll just scroll down here on this Iridium page. If you scroll down, oh, I'm sorry. You know what? Let me take you out of the Iridium page, and you'll need to go to the regular page because you've already invested in the blueprint. Okay, if you scroll down here, the Radioactive Trading CD bundle has got a discount right now to where it's essentially the difference between owning the blueprint and the home study kit. Okay, it's essentially that. It's close. You know what? Write me, would you? Write me at Radioactive Trading, Kurt F at radioactivetrading.com. I might be able to get you a further discount all the way down to what you would normally pay. I think it should be $260. Yeah, $260 is the difference between this number and that number. I can get you that. Okay, so that's a great question. Okay, so in order to answer the question for Mr. Good Looking, Rick, okay, Rick, let's clear this out of the way. Rick's question is regarding the put option. Why not go deeper in the money, okay? So here's the thing. This July $60 put option, okay, is in the money and far away, all right? And what happens if you look at this green line, that is today's stock price, okay? Today's stock price. And what I would like to do is I'd like to hold it for only a month and then reconsider. If after a month I'm making a profit, great. If after a month I'm standing still, I might reconsider whether I want to do it or not. If it's going down, well, I'd probably like to get out, but I'll get out at a much lower loss than if I hold it until expiration. Does that make sense? Okay, now, that is the plain vanilla. Now, what if we were to go deeper in the money? Look at how much we have done here. Here's our break even on expiration Friday, okay? And here's what our value is on, and our loss is on the 29th if it stays flat. Now, if I go deeper in the money, I will lose less. I will lose less. Instead of July 60, let's go July, come on, I'm trying to open it, a July 65 put. I lose less if it goes against me. Come on, now it's not cooperating. Okay, there we go. I lose less if it doesn't go, if it goes against me. That's a benefit of going deeper in the money. But here's a problem. It takes a lot more movement before I can get a profit. Okay, so we've actually taken down our risk down to 0.8%. Our maximum risk is only 54 cents. But you know what we've done? We've virtually guaranteed that we're going to lose that 54 cents. If the stock doesn't get to 65, well, it's going to be hard row to hoe. Now, the only caveat to that is if you discipline yourself to definitely get out, before expiration. If your stock starts going up, you will be able to figure something out. Okay? But if the stock stays flat and you hold it long enough, you're going to definitely lose. Okay? So it just makes it harder. If your put option is deeper in the money, there's less that you could lose, but it's more certain that you will lose, if that makes sense. Okay? All right, cool. Other questions? And it's hard to use income methods, right? Yes. Okay. So Rick and I are still conversing there. Rick said, and it's hard to use other income methods, right? Yeah. I mean, imagine this. Okay, you've got your stock that's you've got your put that's way deep in the money. If you want to sell a $60 call, that's going to be suicide. Watch this. Okay, I sell a $60 call against this, against having the $65 put. And watch, I'm going to shoot myself in the foot here. Ouch. Okay, if the stock decides to go up at all, I'm going to start, really being in trouble. Okay. On the other hand, if your stock stays down, that could be good. You could end up bulletproof, right? But as the stock goes up, it's like shooting yourself in the foot. Okay, you could lose more than 3 times what you could possibly gain, and that's never cool. Okay, it's a visual wow. Yeah, yep. So, yep, you're welcome. Cool. Okay, gang. Well, hey, it's that time. I'm going to go ahead and close her up. I need to get to another meeting, so we'll see you out there. Happy trading, and I suppose I should flash this up one last time. I'll put up the the phone number and support at radioactivetrade.com. And for my friend that wanted to get coaching, it's Kurt F. That's me, Kurt F. at radioactivetrade.com. Okay. All right. We'll see you out there, folks. Happy trading, and bye for now.